Hello everyone, welcome to Group D from International Financial Management at Wollongong University in Dubai. Our team have 4 people, Tariq, Mohammed, Manshin, and her. Today we are going to present 4 presentations related to financial management subject. In presentation 1, we will present solutions for week 3 questions we download from source.
The export module includes the indirect export and the direct export. The indirect export refers to the enterprise through the domestic middleman to engage in the export of products. Instead of dealing with export documents, insurance, and the transportation, the company can use the existing sales channels of the middleman. The export means that the enterprise has its own foreign trade department or use the middleman in the target country to export the products. It is beneficial to reduce the expenses of middlemen, accumulate the experience of the international marketing, and improve the international visibility. However, the business volume may be small, and the lack of the understanding of the foreign markets leads to insufficient marketing stages. In the mode of license entry, enterprises transfer their industrial property rights to foreign enterprises in a certain period of time in order to obtain the commissions and the earnings. Designing the basis import the barriers and carries little political risk, but it is not a good way to control marketing planning and the programs in the target country, and it may also make the licensing a strong competitor. Joint venture refers to joint investment, joint operation, joint share of the equity and the management rights, and joint risks with the enterprises in the target country. Joint ventures can take the advantage of the partners' mature marketing network and are easily accepted by the governments due to the participation of the local companies. But with the shareholdings and the management deposits, coordination can be difficult and joint ventures can become rivals. Sole proprietorship refers to the enterprise which directly invests in the target country or merges with the target country. The enterprise can have the complete control over management and sales, and often distribute the profits. So sole proprietorship requires the greater capital investments, and the expansion of the market size is easily limited, and may face greater political and economic risks.
How did the money-leaking online bookstore become a wealth creation machine and the darling of Wall Street in just 20 years? The envy of corporate America and the rest of the world? In 1994, years before marketplace platforms like Paper, Uber, and Airbnb, Bezos realized that digital commerce would radically transform the way the world does business, and he realized that in order to monetize that insight, his company would have to reinvent logistics. He bet big by focusing on growth at the expense of net income, reinvesting proceeds into building a diversified giant that touches every aspect of our lives. The company continues to pump most of its cash into big strategic plays like Prime, Amazon Studios, Amazon Web Services, and Alexa. Amazon is a company of companies tied together by extraordinary leadership. Amazon has 1,298,000 full and part-time employees by 2020. Amazon is a leading e-commerce retailer in the US with over $386 billion in 2020 net revenues. The company has far more employees than Google and its competitor eBay. Amazon's business model has been puzzled by analysts for years. The company, rather than focusing on pushing profit margins, pushed to generate cash flows that could reinvest as much as possible in the growth of business. Amazon's marginality has improved substantially, primarily due to other revenue streams. In Q1 2020, Amazon's net sales increased by 26.3%, yet its operating income decreased by 9.7%, primarily due to a high cost of sales incurred by Amazon due to COVID, due to increased shipping and fulfillment costs and marketing expenses. In order to enter the emerging markets early, he had to choose e-commerce companies in promising developing countries like Souk to conduct acquisitions and mergers to gain a leading position in the emerging markets so that he could understand the behavior of local buyers earlier. Only in this way can we effectively prevent the fate of premature elimination.
Alright guys, welcome to the next video on the channel. This is week 4 from the term, group D. Our task is about problems part. Alright, bid price. What does bid price mean? Is the highest price of a buyer which he can agree to buy a currency or securities, while the ask price is the lowest price for which the seller can sell his currency. Mississippi Mud Pies acts as a seller, as it is an American firm that requires the exchange for dollars, and the banker dictates the bid and asks the price. Therefore, to find the price of 1 million Swiss, the company must divide that million by the bid price of the dollars quoted by the banker. So this is the answer of the problem 1 that we got in our task. Group D, Tariq Muhammad, and thank you very much.
When calculating the price of the currency relative to the other two, there is always a possibility of triangular arbitrage. Triangular arbitrage results from a divergence between three foreign currencies that occurs when exchange rates don't match exactly. These opportunities are rare, and the traders who take advantage of them have modern computer hardware or software to automate the process. This type of arbitrage is a risk-free profit that occurs when the quoted exchange rate is not equal to the market cross exchange rate. International banks that create volume exchange markets exploit market inefficiencies when one market is overvalued and another undervalued. In this case, to avoid triangular arbitrage, the direct price of the yuan to the Thai baht is taken as the basis, which should be equal to the dollar in yuan multiplied by the dollar price of the baht.
The bid-ask spread is the difference between the price at which traders buy and sell a currency. In the retail market, however, the spread between bid and the ask price for currencies in lower demand can be large, and conversely, there can be large difference between the different bidders. Money is considered the most important liquid asset, and because of the large amount in circulation and the bid-ask spread in the money market in the smallest, which can be just a few cents. For example, someone needs dollars, and 1 euro equal to the $1.4. If you need to buy 5,000 euros, you have to pay the dealer $7,000. If then needs to convert 5,000 euros into dollars, 1 euro increase to the $1.42. He would get the $7,100 with the spread of the $100 and a percentage the bid-ask spread of the 0.02.
Hey guys, what's up? Welcome to the 5th week of fin241. This is week 5. 3 questions here we got. I am Tarek from Group D, and I'm going to say the answers of the 3 questions that we have to share it up with you. First question is saying, if the yen is selling at a premium relative to the euro in the forward market, is the forward price of euro per yen larger or smaller than the spot price of euro per yen? So as we know, the yen is the Japanese currency. So in order to answer the first question, we can consider that the 1 yen is selling at a premium in forward market, means that the yen will buy more euros in forward market compared to the spot market. And it means that the euro per yen will be larger, obviously, as in the future forward the euro will be more, so euro per yen will be larger in forward market when compared to spot market. The second question is saying, like, what do we mean by expected future spot rate? A simple definition for it, it is the exchange rate between two currencies to prevail in the spot market on a given future date. It differs from the current spot rate primarily by the next extent to which inflation expectations in the two currencies differ as well. The third question and last question says that if you are a US firm and owe someone 10,000 yen, let's say, and you have to return it in 180 days, what is your transaction exchange risk? In order to answer for this question specifically, because you owe this person 10,000 in 180 days, you have a transaction exchange risk, because if you do nothing to hedge and the yen strength will take more dollars to eliminate your yen ability. So these were the answers for the 3 questions from Group D again. Thank you so much.
In the forward market, the spot value of euro per yuan would be less than the value of euro per yuan when the yuan is trading in the forward market at a premium. The contingent average of the probability density function of future spot price is the anticipated rate of the future spot. The likelihood function defines all probable new spot rate discoveries of the rate of future spot understandings and gives possibilities to those quantities or variations of currencies. The firm will have a transactional exchange risk since it owns 10 million in 180 days, and if no action is undertaken to hedge and the value of the yen increases, more dollars will be used to pay up the yen liabilities. Furthermore, insinuate that clients' transaction conduct and understanding of trading do not line up for the payment dichotomy.
My name is Mohammed and I'll be starting with the question 1. Should MNC borrow primarily short-term when short-term interest rates are lower than long-term interest rates, or should it keep the maturities the same but use a floating rate loan rather than a fixed rate loan? Explain. Firstly, the short-term interest rates are lower than long-term interest rates, which signifies that there has been a significant increase in the interest rates. Whereas if the interest rate is constant, then it has been understood that the long rate is considered as weighted average of short-term rates. Loan that is having a floating interest rate allows for low interest payments when short rates are said to be low, and high interest payments when short rates are high does not provide any result. Secondly, the difference between borrowing the short term and using a floating rate note, the note could create various negative impacts in the future on MNC's credit spread. But last but not the least, if the firm is assured that its credit rating will be improved in the near future, then it may not be willing to issue a floating rate note, whereas instead of issuing a floating rate note, it will be willing to borrow a short term and also a good credit spread. So now moving to the second question, which states that what are the 2 main segments of the international bond market and what types of regulations apply to them? The 2 main segments of the international bond market are foreign bond market and the euro bond market. Under the foreign bond market, the foreign issuer issues bonds in a given respective domestic market, and in the Eurobond market, the bonds are issued contemporarily in various markets outside the national boundary of a given country.
What's up, guys? Hope you're doing all well. Welcome to another video of week 10, fin241. Subject Tariq Muhammad from Group D, ID number 5718260. Alright, starting with the following, we've got to answer question number 5 from week 10 and week 10 task, and we've got to solve a problem which have an AB. Alright, so let's start with question number 5. what is a credit rating? What is a credit spread? Should corporations issue bonds in countries where they face the lowest credit spreads? Be very specific about the concept of credit spread you are using. Alright, so I admit that this question is not perfectly accurate, but I've got to answer what I got from my research. A credit spread is the risk premium added on to the base interest rate used when pricing corporate debt issues. And it reflects the credit rating or risk rating, as they say in the markets, of the company, the maturity of the issue, current market spread rates, as well as the other components such as security and liquidity. This is all I got for this question. I got to make sure to read other people's presentations as well. But moving on to the problems, I think I've done very well. I've found many things about it. Let's move to the problem and read it for you carefully, alright? So, problem. FE company wishes to raise $1 million with debt financing. The treasurer of FE company considers two possible instruments. First, 2-year floating rate note at 1% above 1-year dollar LIBOR, on which interest is paid once a year. 2-year bond with an interest rate of 5%. Currently the dollar LIBOR is 1.5%. Alright, so starting with the first question, is it obvious which security the treasurer should pick? From the answers I got that it is not obvious at all which debt to pick, while the 2-year floating rate starts out at a lower rate, not a higher rate, which is 2.5% versus 5%. It is not clear at all what the eventual cost of the note will be in order for the company to pick. So the cost will also depend on the reset of the interest rate in the second year as well. If that interest is higher enough, then the 2-year bond may prove to be the cheapest financing. While an upward sloping yield curve suggests that the market does indeed expect that the short-term interest rate will rise in the future. And part B from this question was saying that suppose the treasurer believes that 1-year LIBOR 1 year from now will rise at 4.5%, which security has the lowest expected AIS if borrowing fees are AIC, if borrowing fees are similar for the two instruments. Well, that might make some sense because we can do it by calculations, which says that the AIC for the 2-year bond is simply 5%. For the 2-year floating rate note, we must compute the Y that satisfies, which will be 1 million, which will be equal to 25,000 divided by 1 plus Y, plus 55,000 divided by 1 plus Y to the power 2, plus 1 million divided by 1 plus Y to the power 3. Where we computed the coupon payments as 2.5% for the year 1 and 5.5% for the year 2 on the 1 million principal. The solution for Y is 3.97%. Hence, at this forecast, the floating rate note is cheaper than the bond. This was the end of week 10 as well, guys. I hope you a wonderful day and thank you so much for listening. I appreciate it. Bye-bye.
Hello everyone, my name is Mengxing Hu. Now let me explain the first 3 questions. The first one, it depends on the cycle of the multinational lending. If a multinational company can earn a profit by borrowing money in a short period of time and has sufficient credit at present, the yield curve tends to tilt upward due to lower short-term interest rates. So short-term loans with low interest rates than long-term loans are more suitable. If short-term loans and long-term loans of the same circle, and as a result of the long-term bond interest rate is expected in the duration of the arithmetic average of the short-term interest rates. With the passage of time, the different interest rate has a tendency to direction as the maturity of the bonds, which means that the short-term loans and the floating rate combined with the long-term interest rate does not necessarily get the extra income. Compared with the fixed interest rate, floating interest rate is unstable, which will more challenge the credit degree and the budget of the multinational corporations, and it needs to be decided according to the current market state. If the yield curve is steadily upward in the period of the interest rate cuts, floating interest rate can be considered during periods of the instability or rate rise, and fixed rates are safer and worth considering. Worth considering. The second one, and there are two important parts of the international bond market. The first one is the foreign bonds, and another one is the European bonds. Foreign bonds refer to bonds issued by foreign issuers or institutions in the face value of the local currency in the bond market of the other countries, and are traditional international financial market business. The insurance must be approved by the government of the issuing country and governed by the law. Countries have different names and jurisdiction systems for the bonds issued by foreign companies. For example, the foreign bonds issued in China are called panda bonds. Type is the euro bonds. Euro bonds are tradable currencies other than the local national currencies issued by the foreign issuers on the foreign bond market, such as European the currency unit bonds, because Eurobonds are one of the main business in the European currency market, so they will not be governed by the financial laws of the other countries. And the third one, VAR, is similar to the evaluation of value at risk, which is used to estimate the maximum loss of assets, a value that may be caused by the market changes over the period of time. The choice of VAR, the evaluation days, is more subjective. Assets with the large liquidity, such as stocks, can be quickly realized after a short evaluation, while the long-term and the less liquid investment projects, such as the bonds, need to calculate the VAR value for the long time. VAR balance can explain the maximum possible loss under the ordinary the market fluctuations, but cannot predict the loss under more extreme conditions, such as the financial crisis, war disasters, and the other uncertain factors. Thank you so much. The essence of investment is to choose between certain returns and risks, and the portfolio theories use the covariance to measure these two key factors, where a single investment will be vulnerable to the biggest losses directly. Diversification is a better choice, as the mean and variance. The return rate of the portfolio is intended to calculate the risk of the portfolio and try to avoid the risks such as the risk premium. The risk of portfolio is related to the return of the portfolio assets. Through the covariance of the return of the portfolio, we can estimate whether there is the optimal growth of the investment proportions. Increasing the variety of the portfolio assets tend to reduce the proportion of risk, but to a certain extent the management costs will not continue to reduce risk.
I'm going to answer question 5. What the credit rating? What's a credit spread? Should corporations issue bonds in countries where they face the lowest credit spreads? Be very specific about the concept of credit spread you use. Credit spread is one of the most crucial indicators that help investors to make better decisions. Concerning their debt security purchases, the term is defined as the difference between the yields of two bonds with similar maturity dates. Usually the comparisons are benchmarked against the risk-free debt securities, such as U.S. government bonds. In such cases, credit spread indicates the number of default risk that investors embrace purchasing debt securities of certain organizations. It is also important to mention credit rate, as this concept is closely related to credit spread. The former is determined by private entities such as Moody's and Standard and Poor's and shows the trustworthiness of bond issuing organizations based on the firm's ability to service one's debt. Therefore, to raise capital, a company should set the interest rate adequately adequately representing its credit rate and credit spread with benchmark bonds. Only when would an organization be able to balance the potential risks with the potential benefits? For this reason, it is argued that companies should seek to issue security debts in countries where they face the lowest credit spreads due to lower borrowing costs and higher investor trust. Based on the previous description, the formula to calculate credit spread will have the following form. For instance, suppose that the 10-year U.S. government bonds yield is 1.5%, whereas some organizations' bond of a similar maturity date has a yield equal to 4.5%. Then the credit spread between those two debt securities would be 4.5% minus 1.5% equal 3%. Overall, the concept of credit spread, its importance, and its relation to credit rating were discussed. It was determined that credit spread indicates the number of risks that investors embrace purchasing debt securities of certain organizations. It is calculated as the difference between risk-free and the corporate bonds yields, where the former usually represents the debt securities issued by governments. Moreover, it was found that credit rate can influence credit spread.
Price level is a value calculated by weighting or price of goods or services in a certain period in a specific area with currency equivalent value, which can reflect the average price index of the product, and the price index can reflect the change in commodity price levels of a period of time, usually expressed as the relative values. The price level can more directly reflect the degree of the change in the current commodity price. For example, the use of data reflects the decline of the commodity from the 100 to 80, and the price index observes the impact of the overall level of this price change, such as calculating the percentage is 80%. It can be known that total price has dropped by 20% this time.